Hello and welcome back to Building Wealth on the Go, a podcast by KLT Wealth Management. I'm your host, Brad Wilson, joined by my colleagues Courtney Beach and Joe Filiomeni. Today is April 17th, 2023, and we are back with Season 4, Episode 4 of our podcast. Video format this time, finally going live. We'll see how this thing goes here. So we did a little trial run last month. It went pretty good. So we'll give it a shot this month and see how things go. So if you're watching us on YouTube, welcome. Stick around, hit the subscribe button, join us here on the YouTube channel. So let's jump right into recent economic headlines. Biggest thing off the top is the interest rate decisions. It seems to be everybody's got them marked on their calendars for the last 12 months, and I think into the 12 months into the future. So Canada came out, held rates again. So what does that mean? What's kind of the signal from that sort of meeting there?
A bit of I think, the central bank of Canada, I think they're kind of taking a wait and see approach in terms of they've already increased interest rates. Do we need to go a little bit further? Inflation has come down. Now, that could be a number of different factors why the inflation has come down. But somewhat of a signaling that, okay, maybe we don't have to go much higher, or at some point a little bit more higher in order to help that inflation to come down. So it's a bit of that teeter-totter that we always talked about in terms of like a little testing of the market and stuff. So but certainly the market seems to be happy with it.
Yeah, the market's reacted pretty well overall, but it'll be interesting to see what happens here.
Yeah, I think that the Bank of Canada and the Fed in the States are trying really hard not to have that hard fall. And we've already seen with the banks last month that I think upped their worries about us having a hard landing. And so they're being very cautious at this point to try to mitigate that being an issue.
Yeah. And I think, some of what's important to look at, and I think the Bank of Canada, the Fed certainly look at all aspects of it, but it's important to look at the different areas of inflation when we start talking about inflation. And really, all this, tightening is to curb inflation. At the end of the day, that's all we're trying to get under control is inflation, right? And inflation comes in many different ways, right? There's, we talk about kind of core inflation versus, inflation on a broad spectrum. But, some of the indicators that are out right now, the biggest one that you see a lot of people talking about fighting is the labor market. The strength in the labor market is like demand continues to exceed supply. And that's one of the driving factors. You look at wage growth, you look at the amount of people in the workforce, unemployment rates. Those numbers are that of a thriving economy. Whereas you look at the other pressures are kind of going down. You look at energy, different other sectors, but the services industry and the labor market as a whole seem to be extremely strong. And that will probably end up being the toughest battle that these central banks have to deal with as we kind of combat the inflation here.
Yeah, and I don't know if employment is usually an indicator of recession, like you said, but I don't know if we're going to see that as much this time as we did before, because we're in very unique circumstances. So many people were laid off or didn't come back to the market after COVID. They just said, hey, I'm already off. Why not I just stay off or re-gear what I want to do? So you've got that. The other thing is usually because the labor market is so strong, we're starting to see strikes happen. They're happening in Europe. They're starting to happen in the States. They're starting to happen here. It's affecting people. And usually that's not something you would hear of. But with inflation, people need to be paid more so they can buy their groceries and keep their roof over their head and pay their mortgages. So I don't know, this is very unique circumstances this time around.
If we took a look at sort of the technology sector specifically, because that kind of ties into sort of what's happening in the markets, but our understanding is that the technology sector is in recession. There's big layoffs there. They've been laying off, and kind of makes sense because they really ramped up on staffing during COVID. 2020 was really, really big on the technology side. And then we saw last year a huge sell-off in technology stocks, in those technology companies. Why? Because of interest rates going up. Again, technology, big growth orientated, borrows lots of money. And so ultimately, then interest rates are going to go up. Companies are not going to make as much. But just in this last quarter, what's been charging forward?
The top 5 names.
Top 5 names has been technology. None of the other players. So if technology is sort of in a recession, and we can identify with that, and there's layoffs and stuff, at some point that's got to trickle into the general other sectors of the economy to some degree. But how do you do that with this wage inflation and people wanting more money, I guess, in order to get the thing?
It's got to be sector based, right? Because we've seen the layoffs in the tech sector, right? We saw them at the end of last year. We saw them at the beginning of this year. So, and like a lot of people say, and we've talked with portfolio managers, even internally with the investment teams here, like the technology sector is effectively in a recession, right? Like it's gone through those motions. It's just a matter of everything else kind of lagging behind. And that's why I said this time's very different. You look at different inflation numbers for different sectors being impacted in different ways. You're seeing everything flow in sort of a unique manner that we really haven't seen in a long time, and if so ever, to this extent, right? So it's interesting to watch, and that's the difficulty that I would say these central banks have in this day and age, and the current economic conditions that we're going through, is they're trying to manage that, and on top of that, they're hiking these interest rates. And now you look at people who locked in at mortgages 5 years ago in 2018, right? And there's issues now, right? Like you're seeing lots of people lock in 2018, 2019 next year that are coming into these extremely high rate environments.
And I think that's the next thing to kind of watch for, right? And it does take, anytime there's any interest rate moves, it takes a while for it to funnel through the general economy. But like you says, probably a big thing that the central banks are watching is that they don't want to put the interest rates up so high because of all these people with massive debts, like $800,000 mortgages and stuff, because house values were crazy. So, okay, what do we do, right? Do we increase interest rates just for the sake of bringing inflation down and then have a hard landing? And I guess that's what they're trying to manage: hard landing, soft landing. And obviously it's going to affect everybody individually and stuff. So, but I believe the signal for sure is higher interest rates, maybe at this level, maybe slightly higher, but for longer. So whereas I think the market was positioning that by midsummer we'd get a bit of a reduction in interest rates just to kind of start stimulating the economy if we were in a recession, I think it's pushed out to the end of the year, possibly 2024.
Yeah,
I think a lot of this recent rally we talked about in the markets the last couple of weeks, I think that's fueled by that, right? Leading into these rate decisions, I think people are like, we're going to get rate cuts this year. We might get 2 rate cuts this year. Who knows, right? And I think that's just because you see that initial inflation number coming down, but bear in mind, they're not cutting interest rates until they really wrangle inflation down into that 2 to 3% range.
That's right.
Right. And like I mentioned before, there's aspects of inflation coming down, but wages, that's going to be their tricky one, right? The wages in the labor market, if there's still strength in the labor market, the service industry, people are still spending money because they're making good money. Right. So yes, stuff costs a little bit more, but they're still spending the money. And because they're making the money, they've got those jobs that pay them really good salaries. Right. So I think from that standpoint, inflation will get to a point, and I think we might see a plateau, right? We may see a plateau in inflation at maybe that number is 4%, right? Maybe it's 3.5%. We may see a plateau, and that could drive them to hike rates again. We may even see them forecast that plateau and hike rates in the next month or two again. And then I think you're right, Joe. I think through this year, and people who are expecting maybe a cut this year, the narrative from the central banks is don't expect a cut anytime soon. They keep pushing that, but there's a lot of pushback on their narrative. But I think you got to listen to them, right? Like, what's the saying? Don't fight the Fed.
Yeah.
Right.
Yeah.
Like, you know, if they say this is going to happen, I know people say, well, how can you take their word for it? They said they wouldn't hike rates till 2024, and then look what happened last year, right? So I think, you know, there is a lot of, you know, there's going to be a lengthy period of time that we're going to be at these high rates, and I think the market will probably reflect that once that settles in a little bit more towards these summer months, right?
Yeah, there's a lot of talk that especially certain sectors in the market are overvalued right now because people are overly optimistic about inflation and how the labor market and everything is going to actually affect the companies.
Yeah. And so let's continue on that sort of topic of housing, home prices. Recently just came out, there's the projection of home prices to be down an average of 5% in Canada in 2023, which doesn't seem like a lot, right, for a sector that kind of ran up.
Well, it was inflated, right? So it needed to start coming down to some level, and I think still it's still pretty inflated because there's still lots of demand, and with interest rates holding, I think that's sparking new demand.
But at the same time, I know we've been at a like 20-year low for quite some time, but I've been just reading articles in the last day or two that the housing market is starting to come back. People are actually starting to go out there and buy there, because no matter how much the houses cost, there's still only a finite amount of houses available.
That's right.
And so it's not that people don't want a house, it's that they're just waiting for the opportunity to buy the house. And I think at some point people are just going to get tired of waiting. And if the interest rates aren't going to go up, then they're going to get in now because, hey, we need a house to live in.
And I think it's important to note too, when you look at the two different environments that you can get into buying a house, especially if you're a first-time home buyer or you've been renting recently and you're looking to get back in. Buying a house in a high rate environment, you're qualifying for a mortgage at the highest, you know, arguably the highest interest rates can be. So especially if you go variable, but even if you go fixed, by the time you renew, interest rates are likely going to be lower than when you've settled
Maybe
in.
not a lot.
Maybe not a lot. But I'm saying
we're not going back to 2%.
No, I know. But you know, if you lock in, let's say at 4.9 now, you might get 3.75 when you renew in a year, right? So you look at the reverse and sort of how we talked about those people leading up to COVID who've locked in rates, who haven't seen these rates before. Whereas the people getting in now, if you can qualify for a mortgage right now, if you can qualify for a payment, you know that's likely the highest it's going to be. And you've even been qualified for a 2% increase in those rates.
Well,
right?
The thing is that we've had low interest rates on mortgages for such a long time. And as a financial planner, it's actually been, or advisor, it's been a difficulty trying to tell your clients that, okay, it's 2% now, that's really great, but can you afford more? And they would look at us and go, well, why do we have to afford more? It's been 2% since forever. It's never going to get really high. And now we're in the situation where it is high, and there are people who are struggling. So like you said, Brad, in some ways it is a nice thing that the rates are higher, because they know they qualify for those higher rates. So when they come down, hopefully their cash flow will be a little bit better. The only thing is how much of how more along of the amortization are you going to go? Like we say that the rate is going to go down maybe by the end of the year or next year, but what if it doesn't? So now we've got people who are playing this game of the interest rates. They don't want to pay too much, but they don't want to be able to take the opportunity when the rates start going down too. So this is a tricky thing for people to try to navigate.
I think you're right too on that aspect. I think interest rates have almost become a game because of how low we saw them.
Sure.
That people are now betting on, okay, I'm going to do a 1 year lock in. I'm going to, or I'm going to go variable for a year, and then I'll flip it to a fix once the rates get down to 2%.
It's a dangerous game.
And it is. Yeah. Right. And for people who don't have, we talk about risk tolerance a lot, right? In the investing world, you have to have some risk tolerance for how you handle your debt as well, right? Especially when you're locking into a rate. You want security knowing your payment's going to stay the same. Do you want security knowing that that's not going to fluctuate, right?
And on that note of the game is, when my parents bought a house, it was to live in. But in the last 10 years or so, property has been more about increasing your net worth.
Yes.
It's been more about an investment. Hey, okay, I don't have to worry about putting away for my retirement because my house is going to be my retirement. But the thing is the houses have become so expensive. If you sell your detached home and you go to condo, it's not as big a difference in price as it used to be. So yeah, you've increased your net worth, but the costs aren't the cost difference. Like it's not there as much as it used to be. So people have to really rethink the housing market and how it's going to play into their overall finances.
And I think there's a squeeze in real estate investors now,
Mhm.
right? They're talking
Yeah.
about a lot of real estate investors being forced into liquidating properties, selling properties, which in a what like
Additional
they say,
fees and stuff like that are being charged.
Well, that,
Toronto
right?
area.
and the
That's
service
all.
industry, like we said, is running strong. You know,
Mhm.
you look at utilities, they're not getting any cheaper. You look at the cost of everything. So the cost of owning these investment properties are going up, and they're not able to hike rents significantly because there are rent caps right here in Ontario.
Mhm.
And which I think is probably a good thing, considering we could have outrageous rents. I think especially in some of these major cities, had if there wasn't such a cap, right?
Yeah.
So
Mhm.
but I think that's where it was almost like everyone was hopping on the train of getting an investment property,
Oh,
and then it was like a fad almost.
I think they still are. We still
Yeah.
have clients saying I need to buy real estate, but
Yeah.
like a lot of this at the price values that are out there, at the market values that are out there, as an investment, it doesn't carry. You'd have to charge a significant amount of rent in order to carry that particular investment.
Yeah, and another thing is property taxes have been frozen since the pandemic started. At least they have in my region.
Yeah.
And they're due to be increased next year.
Yeah.
And these properties have doubled, sometimes even tripled in price. So I don't know how the government's going to handle it, or clients are going to handle it, seeing that bigger property tax bill on top of the bigger mortgage payments they're paying.
Yeah. So I think sort of the moral of the story for some of our listeners out there, in terms of if you're looking to buy a house, like make sure you get all your ducks in a row.
Yes.
Know your budget, know your stuff. Shop around, for your mortgage and stuff, and make the decision as to variable or fixed, and just stick with it. And it is what it is type of video.
And the other thing is, make sure all of these things fit in your cash flow, because sometimes the mortgage broker will say, hey, you qualify for this $1 million mortgage, but when you crunch the numbers for your cash flow, no, you can't. And especially if the rates and the property taxes and fees are going to go up, it makes it even tighter for yourself. So just be cautious.
Because the thing to note is qualifying means 43% of your debt income ratio at kind of your peak, right? Including property tax and everything. But can you afford to put 43% of your income in your gross income to debt payments, right? Or because maybe you want to spend your money on something else, right? And if you have that, you have to make that adjustment.
And other things are going out in price, like groceries and stuff like that too. So you got to keep that in mind.
Well, that lends into those listeners that are out there that are going to be renewing. Start working on your budget, your cash flow, understanding your expenses. You may have to tighten up in certain areas, just anticipation that payment is going to be higher when you go to renew. So like, be prepared for it, and don't just wait. Like, get ahead of it. And for those that are maturing in the next couple of years, next year, for example, or the following year, prepare for it now. It's always best. So there might be a couple of trips. I can't do a couple of trips this year because, like, there's a lot of uncertainty there. There's nothing wrong with that, right? Like, I think, again, the mentality has to be that I need to shift my expenses, and you can do it. They're your expenses. I can shift in order to accommodate potentially what's going to happen in the future for me.
And there's a lot of mortgage products out there. You can look into it, but have a conversation with your advisor, or your financial advisor, your mortgage broker, whatever, on can you add $100 to each of your payments now, because your payment's going to be higher when you renew anyway, or you're going to be forced to amortize it longer. Can you add an extra $100 now into your payments to get ahead of it, lower that principal upon renewal?
Yeah.
Can you add a lump sum? Did you get a tax refund this year?
That's right.
Whenever CRA
Refunds
gets
coming
back
out.
to work and sends you the tax refund back.
Yeah.
But did you get a tax refund? Dump that onto the mortgage, or a
Yeah.
portion of it onto the mortgage, right? There's different strategies out there that'll help set you up, especially if you're renewing this year, and also for next year as well.
Yeah.
Within the next sort of 12 to 18 months, I'd say, if you're renewing, get on that now and get ahead of that.
Yeah, and my only caution, you sort of touched on it, is to talk to your mortgage broker, because some mortgages only allow you to pay a little bit extra, and if you pay more than that, then you have to pay fees. So
Yeah,
definitely make sure you read the fine print before you make a plan.
absolutely. So I think we should kind of switch gears a little bit back into the sort of the markets, and talk a little bit about earnings seasons. We're kind of in the thick of it right now. These next couple weeks, big names, some tech names, financials, some consumer staple. Like there's gonna be some big earnings reports. So the markets are kind of on watch here, as we kind of look out into the next few weeks. And April, one of the bigger months for earnings and stuff. So what are we kind of looking towards here? What's the sense in the markets when it comes to earnings coming up? I know we touched on some of the pressures regarding inflation, but what else kind of on the horizon here? What have you heard?
Well, certainly the impact of the interest rates is going to have, we want to see how that is affected within the earnings of a lot of the companies and stuff. And, with any luck, if most companies hit somewhat of a target and stuff, it should sort of hold. It seems like the market really wants to hang on to its gains and keep going, right? But again, in certain sectors, of course. But we'll have to sort of see and how it all plays out, and really we'll see what the emotion is at that point with the markets.
Yeah, and remember, companies always forecast their earnings low, so that they can beat it, because everyone loves a good story. So if they do come out with companies doing less than they thought, it's just something to think about, really, because usually they already are pricing on the low end.
It's almost like we're waiting for a shoe to drop, though.
Yes.
Right. Like I think there's a swirl of news and headlines that come in, and you think, oh, this might be one that tips the market one way or the other. Right. And we kind of entered this. We had that little bit of a run up there the last couple of weeks, but we kind of entered this holding pattern, like you said, Joe, and we're almost waiting for that one shoe to fall, because it almost feels like we're not out of the woods yet. Based off of what's going to happen, we still need to get inflation down. Yeah, it's coming down, but until we really get everything under control, there could be any trigger at any moment in time that sends us into a bit of a pullback.
Yeah, because recessions are usually, I think there's about 7 indicators, depends on who you talk to, that indicate we've been in a recession. And usually it's not when you're in it that you find out you're in a recession, it's after you look back at data and you figure it out. But it is, I agree with you, everyone's waiting for this one thing, maybe because our last couple of recessions were a one thing. Like we had 2008, that was the banking crisis, and then we had COVID, and there were very distinct events that happened that caused the recession. I don't know if we're going to have that this time, but you never know. But everybody's waiting for that one thing. And I think when the banks last month had problems, people thought that would be it, but then the government stepped in and kind of fixed the problem or smoothed it out. So I don't know.
And that's another thing, though, right? Is the government came in with more stimulus.
Yeah.
Right. So again, like we were kind of just getting out of that whole stimulus thing, and now there's more stimulus. So is that a false sense of security in the market again, right? Because stimulus has got to come from somewhere, right?
Yeah, and I understand why they stepped in at that point, because it's the banking system. You need to have trust in the banking system.
And we went through 2008.
But at the same time, if you don't let companies that aren't being managed well fail, even if it is a bank, then we're not going to have the recession that they so badly need for the inflation to go down. So it's kind of this, like you said at the beginning, it's this scale. They want the recession, but they want it to be in a certain way, I guess.
I'm trying to manage what type of recession.
Yes.
But there is a train of thought with some analysts out there and portfolio managers that the government shouldn't step in.
No. Yes.
And they should just let things fall and crumble and stuff. I remember in 2008, there was a lot of very vocal people saying that there shouldn't just let them fall. Companies are going to fall, they're going to fall, right? If they can't survive. The problem with that, I feel personally, is that it really pushes everything in the general economy down to the point where it's really harder even for a well-established and a good, solid company to get back up.
Yeah.
And I think that's the problem. So whereas the bank and the central banks and the governments are trying to help, soften that to some degree, it makes sense that they need to have that happening. I think, in the 70s, they put interest rates up like crazy, figuring they would help us get in a recession, and just kept us in a recession for a longer period of time.
Yeah.
So,
and I think since the Great Depression, like 100 years ago, the banks have been trying to figure out how to navigate a recession, because they've messed it up a few times. Like they didn't stimulate, then they overstimulated, then they put up their interest rate too high, so now they're trying not to put up the interest rate. So they haven't found the magic pill, I guess, to fix it. So
yeah. Well, and sort of on all of what we've chatted about today, Joe, we've got potentially a interesting event for people to come and check out here.
No, for sure. And June 8th, we're having our Chief Investment Officer, Larry Berman, who will be doing a presentation for really the general public. So it's open to everybody. It is a prospecting event, and it would appeal to a lot of people with assets of $250,000 or more. And look to our website for signing up for the event. It is a free event, but we do require registration, and it's going to be held here right across the road, Puttycombe House.
Right across the street,
Yeah, so Puttycombe House between 7 and 9 and stuff. So there'll be more information in the weeks following. So looking forward to seeing some of our viewers.
So just check out the website. The link will be in the description if you're watching on YouTube, and stay tuned for that. You can also subscribe to our newsletter. There'll be information coming out for that as well. But thank you so much for tuning into this month's episode of the podcast. We will be back in May with episode 5. We'll see you then.